Okay. So guys, in the last class we were discussing depreciation, right? One point that we missed to, one point I missed to point out in the last class was that, please write this down. Only physical assets, only physical assets with finite lives are depreciated. Only physical assets with finite lives are depreciated. Physical assets with infinite lives are not depreciated. Only physical assets with finite lives are depreciated. Physical assets with infinite lives are not depreciated. Guys, can you give me an example of a physical asset with an infinite life?
Land.
Yes, land is a physical asset with an infinite life. So land is not depreciated. It's not a depreciable asset. Please keep this in mind. Okay. So next topic is how to recognize a bad debt expense. Guys, how to recognize a bad debt expense. Please give the heading how to recognize a bad debt expense. Okay. Okay, so when sales are made on credit, there is some chance that the customer will default. Now, there are two ways to recognize such losses. Now, such losses incurred by you when your customer defaults in paying what they owe you is known as bad debt. Right? So, what is bad debt? What is bad debt, guys? Basically,
The amount which cannot be recovered.
yes, the amount which cannot be recoverable from your customer, right? Or, if the customer defaults in paying whatever he owes you, the amount that he defaults is known as bad debt. Now, there are two ways to recognize this bad debt expense. There are two ways. The first way is to wait for the customer to actually default and then recognize a bad debt. First is wait for the customer to actually default and then recognize a bad debt. Okay, so I'll give you an example of this. Say you made a credit sale of $100 to XYZ customer. So in your income statement, say in year one, we are standing in year one, we recognize a credit sale of $100. Right. And by the end of the year, your XYZ customer did not pay any amount. He did not pay anything. The entire $100 is outstanding. So what you do is that in your balance sheet, you record a accounts receivable of $100. Now what is accounts receivable? Accounts receivable basically records what your customers owe you. Now next year in year 2, your XYZ customer comes up and tells you that, see, I have given a huge loss in my business. So, since I have given such a huge loss in my business, I won't be able to repay $40 out of the $100 that I owe you. So, with a very heavy heart, we write off accounts receivable by $40 and recognize a bad debt expense of $40 in the income statement of year 2. Right? So, guys, is this accounting treatment consistent with the matching principle? Yes, please tell me.
No.
No.
Is this consistent with the matching principle?
No.
Why?
Because in match Matching concept says that whenever the expenses happen, the same we recognize on the same period.
Yes, so this is not consistent with the matching principle, because matching principle basically tells us, or matching principle basically requires that we recognize expenses in the same period as the associated revenue. So guys, are we booking the sales revenue and the bad debt expense in the same year? Guys, are we booking
Hmm.
the sales revenue and the bad debt expense in the same year? Sankosh, are we booking this sales revenue and bad debt expense in the same year? Sankosh? Okay, so we are not booking the sales revenue and bad debt expense in the same year. We are booking the sales revenue in year one, but we are booking the bad debt expense in year two. So we are not adhering with the matching principle. We are not recognizing expenses in the same period as the associated revenue. So what should we do to adhere with the matching principle, guys? Please tell me. What should we do to adhere with the matching principle? Bolo, guys, what should I do? Okay, so to adhere with the matching
Yes, it is
principle,
from.
what we do is that using historical data, we estimate a bad debt expense, and this estimated bad debt expense is booked in the income statement. In the same year, we recognize the sales revenue. So in the income statement of year one, where we have recognized the sales revenue, we would also recognize an estimated bad debt expense. And this estimated bad debt expense would be based upon historical data. Right? It would be based upon historical data. So this is the broad idea. So the first method is that you wait for the customer to default and then write off whatever amount has been defaulted. Then book a bad debt expense in your income statement. That is, you wait for the customer to default and then book a bad debt expense in the income statement. And the second is that you record, you estimate a bad debt expense, and book that estimated bad debt expense in the same period you recognize the associated sales. Right? So the second method is consistent with matching principle. We should use that method. Right? So guys, please write this down. I am dictating. Any doubts here, please? Is anyone having any doubts here?
Sir, it says like creating a bad debt provision.
Yes, yes. It's just like that. It's just like that. But in the next reading, which is understanding balance sheets, I'm going to go deeper into this subject. In this particular reading, which is understanding income statements, this is what you need to know, right? So first, please write down, the first way is, um, you wait for the customer to default and then recognize a bad debt expense. And the second is, uh, using historical data, you estimate bad debt expense and book this estimated bad debt expense in the same period as the associated sale. And this second method is consistent with the matching principle, right? The matching principle requires the use of the second method, right? The matching principle requires the use of the second method. Any doubts here, guys? Is anyone having any doubts? Uh, should I move on to the next topic, guys? Any doubts here? Please tell me.
No, sir.
Okay. Now, guys, next heading is recognition of warranty expense. Recognition of warranty expense. Okay, so when you sell goods and give a warranty, there is a chance that some defective product may need to be replaced or repaired. Now, such a replacement or such a repair will cost you something, and this cost is your warranty expense. Now, there are two methods to recognize the warranty expense. Again, the first method is to recognize warranty expense when the warranty is claimed, and the second is, you know, we should use historical data to estimate a warranty expense and book this estimated warranty expense in the income statement in the same year we book the sales revenue. So guys, please tell me which method is consistent with the matching principle, the first method or the second method? Please tell me.
Second.
Yes, obviously the second method is more consistent. We are, we recognition of warranty expense as a similar treatment as your bad debt expense. Right, guys, should I move on to the next topic? All good? Yes or no? Bolo? All goods, guys, or no?
Yes,
Yes,
sir.
sir.
Good, sir.
Okay, now move to the next topic, recognition of amortization expense. Right, so what is amortization? So basically, what depreciation is for tangible physical assets, amortization is for intangible assets. What are intangible assets? Can someone tell me what are intangible assets?
Sir, IPR.
Patent, copyright.
Yes, so basically assets that you cannot see and touch or your intangible assets, right? Something that you cannot see, something that you cannot touch are intangible assets, and examples of intangible assets are licenses, patents, trademarks. All these are your intangibles. So what depreciation was for tangible assets like building, property, plant and machinery, amortization is for intangible assets like licenses, patents and trademarks, right? So basically we can say that amortization is the allocation of the cost of an intangible asset over its useful life. And again, what depreciation is for tangible assets, amortization is for intangible assets. Okay, methods for calculating amortization are the same, SLM method and accelerated method of depreciation. Accelerated method, right? So methods of calculating amortization is similar to the methods of calculating depreciation. And as with depreciation, total amount of amortization remains the same over the useful life of the intangible asset, irrespective of whether we use the SLM method or the accelerated method, right? So just like depreciation, total amount of amortization remains the same over the useful life of the asset, irrespective of whether we use the SLM method or the accelerated method of depreciation. Okay. Now the next thing is that guys, only uh, only intangible assets finite lives finite lives are amortized. Intangible assets with infinite lives intangible assets with infinite lives are not amortized. They are tested for impairment. Now guys, what is impairment? Any idea? Guys, just like a tangible asset, just like a physical asset with an infinite life is not depreciated, in the same way an intangible with infinite life is not amortized. Okay, so what is impairment, guys? Any idea, guys, what is impairment? Can you tell me what is impairment? Okay, so please write this down as well. We will be discussing this in great detail in future readings. Guys, when the fair value or the market value of an asset goes below the carrying value of the asset, carrying value is basically the recorded value of the asset in the balance sheet. Carrying value is basically the recorded value of the asset in the balance sheet. So if the fair value or the market value of the asset goes below its carrying value due to changes in market conditions, due to changes in economic conditions, then we say that the asset is impaired. Right, and we would be discussing a number of impairment tests in CFA level 1. Recently, I was taking a class of CFA level 2 where I had discussed how to calculate or how to measure the impairment of an intangible asset. Right, I had uploaded that as I had uploaded that video in YouTube. If you find time, if you are interested, you can go and watch that, else it's okay. So if the market value of the asset goes below the book value of the asset, we will say that the asset is impaired. And the market value of the asset can go below the book value because of a number of reasons. It may be due to technological obsolescence, it could be because of changes in economic conditions, it may be because of uh, it may be because of damage, it may be because the asset is damaged and that is why its market value has declined, right? So there may be a number of causes of impairment. And guys, impairment of tangible assets, measurement of impairment of tangible assets is in our L1 syllabus. Measurement of impairment of intangible assets is not in our level 1 syllabus, right? So impairment of measurement of impairment of tangible assets is in our syllabus, so we need to be very cautious with this. Okay, now guys, why am I telling all this? Why am I telling all these stories? How to record the bad debt expense, how to record the amortization expense? Why am I telling all this, guys? Guys, why am I telling all these stories? I'm telling all these stories because a company's, estimates of bad debt expense, warranty expense, depreciation and amortization can affect net income, right? All these estimates can affect your net income, right? So guys, a company might intentionally lower the estimate of bad debt expense. It might intentionally lower the estimate of warranty expense. Why would it do so, guys? Please tell me, why would it do so? Why would it intentionally lower the estimate of bad debt expense and lower the estimate of warranty expense? Please tell me.
It will
To
increase
increase net income.
Yes, to increase the reported net income, to artificially inflate the reported net income, right? And if the
Sir,
company
please
has,
repeat.
a company might intentionally lower the estimate of bad debt expense, ठीक है ना? So Shreya, if I intentionally lower the estimate of bad debt expense, that then a lower expense would be booked in the income statement. And if lower expenses are booked in the income statement, then net profit would be higher, right?
Yes, sir.
So a company might intentionally lower the estimate of bad debt expense. It might intentionally lower the estimate of warranty expense to artificially inflate the reported net income. And if the company has newer tangible assets, if the company has just purchased tangible assets, what it might do is that it might use the straight line method to calculate depreciation. Why, guys? Why would a company which has just purchased physical assets use straight line method of depreciation? See, guys, we had discussed that under the straight line method, lower depreciation expense is booked in the early years of the asset's life, right? So if we use the straight line method, what would happen is that we'll book a lower depreciation expense in the early years. And if we book a lower depreciation expense, naturally our net profit would be higher, right? Guys, are we good with this? Have we understood this? Any doubts with the straight
सर
line method?
रिपीट करना एक बार क्या बोल रहे हो
See, if you have just purchased an asset, ठीक है ना? Then we had discussed that the it's here itself, okay. If we had just purchased an asset, we had said that DDM method would result in higher depreciation, SLM method would result in lower depreciation in the early years of the asset life. So if we have just purchased a lot of assets, if we use the SLM method, we will be reporting a lower depreciation or a higher depreciation. Bolo?
लोअर
Lower. And if we report a lower depreciation, then obviously my reported net income would be higher, right, Ankit?
यस सर यस
So if the company has just purchased a lot of assets, it might intentionally want to use the straight line method. Why? Because it would result in a lower depreciation expense, and this too would help the company in reporting a higher net income, right? So the company can use all these stuff to, it can use all these strategies to artificially increase the reported net income, right? We can manipulate net income by estimating, you know by lowering the estimate of the bad debt expense. We can increase the net income by lowering the estimate of your warranty. We can, if you have a lot of tangible assets that you've just purchased, then you can report a higher net income by using the SLM method, right? If you have older assets, right, if you had purchased assets a long time back, then you can use the DDM method, double declining method, because a double declining method would result in lower depreciation in the later years of the asset life. So you can do a number of things to increase the reported net income. So management can do a lot of things, and you know these things are completely legal, right? These are legal. All these estimates are, who's going to question you? See, the auditor is going to tell you that why did you lower your bad debt expense? The management said that okay, the credit rating of my customers have improved. That is why I have lowered the estimate of the bad debt expense, right? Now the company might have 500, 1,000 customers. Is it possible for an auditor to go and check the credit worthiness of each of the company's customer? Bolo guys, is it possible?
नो सर
It's not possible. So these things are perfectly legal. A company can manage its earnings by, you know, uh, lowering the estimates of all these expenses, right? So now what the CFA MAT says is that what your level 1 syllabus basically says that the analyst should find the reasons for a change in the estimate of these expenses. If the firm's estimated bad debt expense has recently decreased, the analyst should check whether the estimated bad debt expense has decreased because of increase in the credit worthiness of the customers, or the company is doing this to increase the reported net income? Now this is very subjective, it's very difficult to estimate this, and analysts should also compare a firm's estimate to those of other firms within the same industry. So if the company's warranty expense is significantly lower than that of a peer firm of comparable size, then the analyst should check whether the warranty expense has decreased because the company is producing high quality products, or the company is doing this to increase the reported net income, right? So as analysts, it's our job to check all this, right? We can't take the net income figure at face value, right? We need to check for all this, right? So when a company declares that it's given a 40% quarter on quarter growth in net income, we need to go and check that, right? We need to go and check that whether the company has not manipulated this figure, right? We need to check that. So please write this down, right? If you lower the estimated bad debt expense, if you lower the estimated warranty expense, if you have just purchased tangible assets and you use the SLM method, all this would result in a higher reported net income. Guys, have we noted this down, please? Guys, are we noting this or not? Yes or no? Please tell me.
Yes, sir.
Yes, sir.
So, analysts should find the reasons for changes in the estimate of these expenses, right? We should not take things at face value. We should investigate the reasons for lowering of these estimated expenses. Okay. Are we good, guys? Have we understood everything? Any doubts? Guys, any doubts here, please? Is anyone facing any doubts? Please ask me.
Good, sir.
Okay, so next time, please, whenever you get a financial report, right? Whenever you go through an annual report, go through all this, right? Check whether the company has lowered the estimated bad debt expense. All these disclosures are given in the footnotes of accounts. All these are given in the annexures, right? This won't be given in the P&L. This won't be given in the balance sheet, right? There are annexures to accounts. There are footnotes to accounts where we find all this information, right? Where the management will tell you that why they have lowered the bad debt expense, why they have lowered the warranty expense, right? Okay. And the income tax department knows all this, right? So what does the income tax department do? Guys, do you know what tax department does? Income tax department tells that I am not going to uh, recognize this bad debt expense until the customer actually defaults. You might have booked an estimated bad debt expense in the income statement in the year you make the sale, but I'm not going to allow that expense. I'm going to disallow it. I'm going to add back that expense to your accounting profits while calculating taxable income. Income tax department says that I'm only going to allow you this bad debt expense when the customer actually defaults. So the income tax is aware of all this. He knows, the tax authorities knows that the company can manipulate in such method. So they disallow these expenses, right? They will disallow this estimated bad debt expense while calculating your taxes. When your customer actually defaults, then the tax authorities would allow this as a deductible expense, right? So the tax authorities are well aware that companies might engage in in such uh, such mischiefs, as in such mischiefs, if I may call it so. Okay. Now, guys, I'm going to discuss a few technical terms. The first technical term is your conservative accounting approach. The other is your aggressive accounting approach. Please write this down. Conservative accounting approach and aggressive accounting approach. Okay, so what is aggressive accounting approach? Now, if the company delays the recognition of expenses to artificially inflate current earnings, then the company is following an aggressive accounting approach. If the company is delaying the recognition of expenses to artificially inflate current year earnings, current year net income, then the company is using aggressive accounting. And if the company does not delay the recognition of expenses, it recognizes expenses as soon as possible, then the company is using the conservative accounting approach, right? So if you delay the recognition of expenses to artificially inflate current year net profits, then you are using aggressive accounting. But you are not delaying the recognition, you are recognizing expenses as soon as possible, then you are following a conservative accounting approach. Now guys, you should not think aggressive accounting as bad and conservative as good. You should not think like that, right? You should not think aggressive is bad and conservative is good. We should follow neutral reporting. We should follow what? We should follow neutral reporting. Now neutral reporting is basically, neutral accounting approach would give a true and fair picture of the company's financial position, right? So we should follow neutral accounting approach. I will explain this later in great detail. We should follow neutral accounting approach because this would give a true and fair picture of the company's current financial position. Okay, guys, any doubts? Should I move to the next topic? Guys, any doubts here? Bolo yes, no?
Good, sir.
No, sir.
अरे साइंस स्टूडेंट शिवाशीष संकुश शिवाशीष आणि संकुश सब समझ में आ रहा है ना? संकुश एलियन बन गया, टुक 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 आवाज आ रहा है, चैट बॉक्स में लिख दे। संकुश चैट बॉक्स में लिख दे, कोई मिल गया का साउंड आ रहा है। चलो ओके गाइस, क्या लिखा है देखें। संकुश मत बोल, लग रहा है एलियन आ गया, छोड़ दे, म्यूट कर संकुश, म्यूट कर। हाँ, कोई लिखना हो तो मेरे को चैट बॉक्स में बोल देना, मैं देख लूंगा। Okay, now guys, we need to discuss what is IFRS and what is GAAP, or rather US GAAP. Guys, what is IFRS? What is GAAP? Please tell me. Okay, GAAP stands for Generally Acceptable Accounting Principles. Right, and basically, GAAP stands for Generally Accepted Accounting Principles, which are accepted standards for financial reporting in USA. So a company in US must follow GAAP while putting together its financial statements, right? So a company in US must follow GAAP while putting together its financial statements, right? And GAAP basically specifies standards for financial reporting, right? And it's followed in US. That is why they name US GAAP. What is IFRS? IFRS stands for International Financial Reporting Standards. And you know, these two are again this too is a set of internationally accepted accounting standards, and IFRS is used in more than 120 countries. GAAP is more or less, the jurisdiction of GAAP is more or less in North America, but IFRS is followed in more than 120 countries. In the Indian accounting standards that we follow are based on IFRS. In India also we follow the Indian accounting standards that are more or less based on IFRS, right? All countries in the European Union also follow IFRS, right? Okay. Now US GAAP was was formulated by FASB, which is Financial Accounting Standards Board. US GAAP was formulated by FASB, right, which stands for Financial Accounting Standards Board. And yes, so your IFRS has been set up by Accounting Standards Board. IFRS has been set forth by Accounting Standards Board in based in London, right? And US GAAP has been set forth by FASB, that stands for Financial Accounting Standard Board. Okay, so guys, what's the difference between IFRS and US GAAP? There are a lot of differences, right? And we will study these differences as we discuss the forthcoming readings in financial statement analysis. But the prime difference is, guys, right, the major difference, if I take a bird's eye view, the primary difference between the two is that IFRS is more principle based and US GAAP is more, no, IFRS is more judgment based. Not principle, that's a wrong word. It's more judgment based, and GAAP is more rule based. So, you know, basically, what I want to say when I say judgment based and rule based is that when it comes to accounting treatment, US GAAP is more rule based, and IFRS leaves a lot to the judgment of the accountant, right? IFRS will leave a lot in the hands of the accountant. It will leave a lot in the hands of, in the judgment of the accountant who's preparing the financial statements, right? So this is the primary difference. But as we move forward, as we discuss the forthcoming readings, I will I will illustrate a number of differences in accounting treatments between IFRS and GAAP. Right, guys, the last point that I want to discuss today is inventory expense recognition. Okay, what is inventory, guys? Any idea what is inventory? Bolo, guys, what is inventory?
Stock. Closing.
Hmm.
Stocks.
Stock in
Products,
trade.
finished goods
Yes,
that
whatever you purchase for reselling.
Selling.
Right? For reselling. That is your inventory. Right. And in the previous class, what did I tell you? Cost of unsold goods is recorded as, guys, what did I tell you? While discussing the matching principle, I told you that cost of unsold goods is allocated to inventory or COGS.
Inventory.
Inventory.
Yes, cost of unsold goods is recorded as inventory. Inventory is reported in the balance sheet, and cost of sold goods is recorded as COGS. What does COGS stand for?
Cost of goods sold.
And COGS is reported in the income statement. Guys, please remember this. Your purchases are not reported in the income statement. Cost of goods sold are reported in the income statement. Many students make this mistake, right? They think that purchases, whatever has been purchased in the year, is reported as an expense in the income statement. No, cost of goods that have been sold is reported as an expense in the income statement. Please remember this. Your purchases are not expensed in the income statement. Okay. So today we'll dig deeper into the subject. Now, guys, there are three methods in which we can calculate COGS and inventory. The three methods that are in our syllabus, please write this down. First is LIFO. What is LIFO? LIFO stands for last in, first out. Right? Last in, first out. Just give me a second. Laptop has hanged. Okay. Okay. Guys, is my screen freezed or is it moving? Last in, okay. Guys, has my screen freezed? Last in, first out. Then we have weighted average method. Weighted average cost method. Please write this down. Weighted average cost. The second is weighted average cost, and the last is FIFO. FIFO stands for first in, first out. Okay, so let's start our discussion with LIFO. Right? So, as the name suggests, right, in LIFO, just give me a second, guys. There is some issue with the OneNote. Take a second. Okay, yeah. So, LIFO stands for last in, first out. And LIFO basically assumes that the last item purchased is the first to be sold. Last item purchased is the first to be sold. Okay, so in LIFO, please write this down. Please write this. I won't be writing this. Please write this. Make sure you write this. The cost of the most recent purchase is allocated to COGS. The cost of the most recent purchase is allocated to COGS, because last item purchased is the first to be sold. So cost of the most recent purchase is allocated to COGS, and cost of earliest purchases is
Inventory.
allocated to inventory. Right? So guys, let us take an example. Say there is a company XYZ. It has just started business. It has no opening inventory. It has no balance of inventory, and takes second, guys. And no opening stock of inventory. Okay, so guys, this company in Q1 it purchased 100 units at rupees 22. In Q2 it purchased 100 units at 24. Q3 it purchased another 100 units at 26. And in Q4 it purchased 200 units at 28. And in the year it had sold 200 units at 40 rupees, right? So we need to calculate COGS and inventory under the LIFO method, right? So in LIFO, the cost of the most recent purchase is allocated to COGS. Guys, what is the most recent purchase? Please tell me. Recent purchase is in Q1 or in Q4?
Q.
228 Q4.
Q4. The recent purchase is Q4. So the cost of the most recent purchase would be allocated to COGS, right? So the most recent purchase is in Q4. So we allocate the cost of the most recently purchased 200 units to COGS, right? So my COGS would be 200 into 28, which is 5600. And the cost of earlier purchases would be allocated to inventory. So my inventory would be 100 into 22 plus 100 into 24 plus 100 into 26. कितना आ रहा है ये? Please tell me. 26 plus 22 is 48.
7,200.
7,000. Guys, my sales is how much? Sales is 200 units at 40. Right? So my sales is 8,000. So my GP would be how much? 8,000 minus cost of goods sold, that is 5,600.
2,400.
So this is how we'll calculate COGS, inventory and sales under the LIFO method. Now let's move to the FIFO method. Now FIFO method basically assumes that the item purchased first is the first to be sold. Please write this down. Item purchased first is the first to be sold. Okay, so now please write this down. The cost of the earliest purchase is allocated to COGS. Right? In LIFO, the cost of the most recent purchase was being allocated to COGS. Here, the cost of the earliest purchase, the oldest purchase, is allocated to COGS. So, cost of earliest or oldest purchase is allocated to COGS. And cost of recent purchase is allocated to inventory, right? So guys, now what we do is basically, guys, we'll take this same data and we'll calculate COGS and inventory under FIFO. Right? Now cost of the earliest purchase is allocated to COGS, right? So guys, we've sold 200 units in the year, so we shall allocate the cost of the most earliest purchase of 200 units to COGS. So what would be that, guys? Guys, the most earliest purchase is in Q1 or in Q4?
Q1 and Q2.
Okay, so the most earliest purchase of 200 units was 100 units in Q1 and 100 units in Q2. So my COGS would be
4,600.
100 into 22 plus 100 into 24, which is 4,600. And the cost of the recent purchases would be allocated to inventory, that is 100 into 26, right, plus 200 into 28. So 200 into 28 is 56. 56 plus 26 kitna hua?
22.
8,200, right? Your sales would remain the same. Your sales is just a second, guys, let me scroll down. Yes, so your sales is 8,000 only. 200 into 40, 8,000, right? So your GP is sales minus COGS, which is 8,000 minus 4,600. Kitna hua? 3,400, right? So in LIFO we had a gross profit of 2,400, and under FIFO we had a gross profit of 3,400, right? So guys, please write this down. FIFO inventory is used for valuation of inventory which has a very limited shelf life, right, which is a perishable item basically, right? FIFO inventory should be used for valuation of perishable items. So say guys, if a company deals in perishable items, then it would like to sell its oldest inventory first so that it has fresh inventory in stock, right? So please write this down. FIFO is used for valuing perishable inventories which have a limited shelf life, which have a very small shelf life, right? So if a company is dealing in perishable products, it would like to sell its oldest inventory first so that it has fresh inventory in stock. Okay. And LIFO naturally opposite. LIFO is appropriate for inventory which are not perishable, which do not depreciate, which do not deteriorate with time, right? So guys, can you tell me inventories which do not deteriorate with time? बोलो guys, बोलो guys, कौन सा inventories do not
Plas-
deteriorate? हाँ,
Industrial items,
yeah, your industry,
plastic.
liquor.
plastic, right? कभी नहीं खत्म होगा. All your non
फ्रूट इंडस्ट्री,
biodegradable
फूड इंडस्ट्री सर, फूड इंडस्ट्री में सर.
food industry क्या?
Perishable है वो तो.
वो तो पेरिशेबल है सैयद. लीफो तो लीफो पेरिशेबल आइटम के लिए मतलब लीफो बेसिकली जो नॉन पेरिशेबल है उसके लिए यूज होगा, राइट? लीफो विल बी यूज्ड फॉर नॉन पेरिशेबल आइटम्स.
Coal.
इलेक्ट्रॉनिक्स
Spice.
एंड रेफ्रिजरेटर.
नहीं, but yeah, so your industrial items basically, you know, the broad classification would be industrial items. ठीक है ना? The broad classification would be industrial items. So LIFO is used for valuing non-perishable inventory. Okay, now last is weighted average cost method. Okay, so in the weighted average, hello, Sayed mute कर ले. So in the weighted average cost method, now in the weighted average for cost method, we first calculate the total cost of goods available for sale. Okay, so guys, in this example, how will we calculate the total cost of goods available for sale? Please tell me. In this example,
Weighted average cost method.
100 into 22 plus 100 into 24 plus 100 into 26 plus 200 into 28. This would
Divided
be
by 500.
divided by 500. Okay, so the total cost of goods available for sale is basically the total amount that you have spent to purchase this 500 units of inventory. How much have you spent to purchase this 500 units? 100 into 22 plus 100 into 24 plus 100 into 26 plus 200 into 28. Guys, do this please calculation. Total cost of goods available for sale is basically what you spent to purchase this 500 units. Do this calculation, tell me really fast. कितना आ रहा है? Guys, how much are we getting?
128 12,800.
12,000. So the total cost of goods available for sale is 12,800. And total units that we've purchased were 500. Right? So we'll calculate the average cost per unit. How will we calculate that? By dividing total cost of goods available for sale divided by the total units purchased. So divide 12,800 by 500. How much is this? Jaldi bolo.
25.6.
25.6. Now what we do is to calculate COGS, what we'll do is that we multiply this average cost with the number of units sold. So number of units sold is into average cost. So we had sold 200 units into 25.6. How much is 200 into 25.6? 5120. And to calculate inventory, we will multiply the number of number of units lying with us, basically number of units unsold, into average cost, which is 300 into 25.6. कितना है 300 into 25.6?
7860.
7860. 7860 यही है पक्का? Okay. So what would be my gross profit, guys?
7680. 7680.
हाँ 7680. ठीक कर लो guys. ठीक कर लो एक बार. Gross profit is basically your sales revenue that would remain the same, that is 8000 minus COGS 5120. What is 8000 minus 5120? 8000 minus
320.
2880. Right. So this is how we calculate COGS, how we calculate inventory, how we calculate gross profit under these three inventory valuation methods. Now guys, tell me what was the gross profit under FIFO? Guys,
2400.
3400. What was the gross profit under LIFO? Guys, LIFO में कितना था?
2400.
In FIFO it was 3400, LIFO it was 2400, and in weighted average cost method gross profit is 2880. Right, guys? So please see that. Just a second, let me scroll things. Guys, see, this is a period of rising product prices, right? Every quarter the price of the inventory is rising, right? In Q1 it was 22, Q2 it was 24, Q3 it was 26, Q4 it was 28, right? So with every passing quarter inventory prices are rising. So this basically means that it's a inflationary environment, right? It's an inflationary environment. It's a period of rising product prices, rising inventory prices. And guys, always remember that during period of rising inventory prices, LIFO will always report the lowest gross profit. During a period of rising inventory prices, LIFO would report the lowest gross profit. And if LIFO reports the lowest gross profit, then a company that follows LIFO, can I say that a company that follows LIFO will have a lower tax outflow? Guys, can I say that?
Yes.
Yes, sir.
So, during period of inflation, LIFO would always result in lower gross profit, lower net profit, right? So it will result in tax savings, right? It will result in tax savings. So LIFO method provides income tax benefits, and since LIFO method provides income tax benefits, IFRS does not allow companies to use the LIFO method because of the income tax benefits it provides during period of inflation, during a period of rising product prices, right? IFRS does not allow companies to use the LIFO method. GAAP allows, but IFRS does not, right? So this is the first difference between IFRS and GAAP. GAAP allows use of LIFO method, but IFRS does not allow the use of IFRS does not allow the use of LIFO. IFRS does not allows use of LIFO. GAAP allows the use of LIFO. IFRS does not allow the use of LIFO. Right? Why? Because during period of rising product prices, during period of rising in inventory prices, LIFO would result in lower GP. Guys, why is why is LIFO resulting in lower GP during period of rising product prices? Can you tell me?
Because COGS will be higher.
Yes, because COGS is the most recent purchase is allocated to COGS. The cost of the most recent purchase is allocated to COGS in LIFO, and since during period of rising prices the most recent purchase would come at a higher cost, so naturally COGS would also be higher, right? So since COGS is higher, COGS is higher, gross profit will be lower. Please understand this. The most recent cost of the most recent purchase is allocated to COGS under LIFO, right? So guys, while calculating COGS under LIFO, we were allocating a cost of 2800 to these 200. We are allocating the cost of 28 rupees to these 200 units, right? But while calculating COGS under FIFO, we were allocating a cost of 22 and 24, that is 23 to COGS, right? So naturally in LIFO we were allocating a higher cost to COGS, and since we were allocating a higher cost to COGS was high, COGS is high, gross profit low, right? Guys, any doubts here, please? Anyone's having any doubts? Please tell me yes or no.
Good, sir.
All good, guys?